For the past 2 years on this channel, I've been recommending Alibaba stock under $100 per share, and that call has worked out extremely well, delivering returns of over 100%. I've recently sold my Alibaba position and moved that capital into a new company, one that really reminds me of Alibaba back when it was deeply undervalued. The company is jd.com, which is down 64% in the past 5 years. The company has a market cap of $41 billion and is currently trading at a forward PE of 9, although we will talk more about the valuation later with the discounted cash flow model. Think of JD as the Amazon of China. It's an absolute beast of an e-commerce business. The industry in China is incredibly competitive. You've got players like Alibaba, Pinduo, Douyin, and Kuaishou all fighting for market share. What really sets JD apart is its logistics infrastructure. If you live in a major city in China, you can often get products from JD in less than a day. Even outside major cities, delivery is usually 2 days or less. This is because JD owns and operates thousands of warehouses across China, giving it a massive advantage that's extremely hard for competitors to replicate. They have seen amazing revenue growth in the past decade, growing from 181 billion Chinese yuan to 1.3 trillion, which is approximately 185 billion USD. And analysts are still expecting good revenue growth over the next 4 years, as they have them growing revenue at a compounded annual growth rate of 8%. Regarding their profit, we are going to see that it is very low compared to their revenue. They are generating 32 billion Chinese yuan in net income and 9 billion in free cash flow, and their margins are really low, as profit margin and free cash flow margin are between 2 and 4%. The reason for this is because they are spending all their money reinvesting in themselves, in the business. This reminds me of Amazon. If we look at Amazon's profit margin over the years, it used to be under 5% because they were spending all that money reinvesting in building warehouses, technology, or robotics, for example. But now the profit margin is at 11% because they've stopped spending so much. I think something similar will happen with JD in the long term. Analysts are expecting a profit decrease this year, but then grow their profit at 52% annually. Then, in order to calculate the intrinsic value of the company and potential future returns, I use my Google Sheet. This tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And as you can see, the intrinsic value according to my low assumptions is $37 per share, middle 68, and high 111. And because the stock is currently trading at around $29 per share, this means that if my low assumptions occur, you would get a 15% annual return on your money, middle 28%, and high 39.5%, which are insane returns, and we can conclude that the company is heavily undervalued. Keep in mind that the market usually gives around 10%, so you would beat the market according to my low assumptions. Now, as far as them, I assume the company grows revenue between 4 and 8% annually over the next 7 years, the average of profit margin and free cash flow margin between 2 and 4%, and I assign the PM price to free cash flow at the end of the 7 years of 14, 16, and 18. But if you want to make your own assumptions, I'm going to leave a link to the spreadsheet down below. It is super simple to use because I've done all the calculations in the background, so you only need to input your assumptions. Now, the spreadsheet does not attribute any value to the balance sheet, but jd.com has an excellent one. This is evident from the fact that total assets amount to USD 100 million, while total liabilities are 57 million. JD also has excellent liquidity, as total current assets are approximately 53 million USD, which comfortably exceed total current liabilities of 44 million, signaling a healthy ability to meet short-term obligations. And in conclusion, I will rate jd.com's balance sheet an 8.5 out of 10. And with this extra cash in their balance sheet, they are returning a lot of value to shareholders through dividends and share buybacks. They currently pay a dividend of 3.4%, and the payout ratio is 32%, which is what percentage of their net income is used to pay the dividend, and anything under 50% I would consider a safe dividend. I am personally not a fan of dividends. I would prefer if the company used this money to reinvest in the company or buy back shares. I believe dividends should be the last resort when the company has no more room for growth. On the other hand, share buybacks are great when the company is trading cheap. We have already seen it is. And they have been buying back shares lately, which is fantastic for shareholders, as you own more of the company and share the profits with less people. So you might be wondering, why is the stock down so much if fundamentals keep improving, the valuation is attractive, they are buying back shares and paying a dividend? Well, it's because of fears of investing in Chinese companies. And there are risks, which are the following 5. Number 1 is regulatory and government risk. The Chinese government can introduce regulations suddenly and aggressively, as seen especially in tech. Number 2 is the variable interest entity structure risk. Most Chinese companies listed abroad, such as Alibaba, JD, Baidu, etc., use a VIE structure. You don't directly own equity in the operating Chinese business. You own shares in an offshore entity with contractual claims on profit. While it is tolerated so far, the structure could be challenged or restricted in the future. Number 3 is geopolitical risk. US-China tensions can lead to sanctions, trade restrictions, or delistings. Chinese companies listed in the US face ongoing scrutiny over audit access and compliance. Number 4 is accounting and transparency risk. Financial reporting standards are improving, but still less transparent than in the US or Europe. And number 5 is currency risk, as returns are affected by fluctuations in the Chinese yuan. So you have to be okay with this risk if you invest in jd.com. And my view is that China remains a fast-growing economy, and while there are certain risks involved, I believe many Chinese companies are priced far too cheaply relative to their fundamentals. The market has already priced in a lot of bad news, which in my opinion creates a great opportunity. Lastly, if you're serious about investing, know that picking the right stock isn't just about the story. It's about mixing in with the numbers. And that's exactly where stockanalysis.com comes in. This site lets you dig deep, track up to 10 years of historical financial performance, see revenue, profit, margins, dividends, everything. If you want a discount code, you have mine in the description. They also have a free newsletter that highlights important market moves and stock fundamentals, which I will leave in the pinned comment. I hope you found this video valuable. Let me know what you think about jd.com stock in the comments, and I'll see you in the next one.